Welcome to the Lane Gorman Trubitt COVID-19 Financial Webinar Series. In this series, our accountants and advisors will provide you with information to make sure your business has the tools it needs to survive the 2020 coronavirus lockdown. This webinar will discuss PPP loan forgiveness updates, review of taxation in regards to when the loan is forgiven, best practices from assisting with the forgiveness applications, and a year-end tax update for 2020. It was recorded live as a Zoom webinar on December 8th, 2020, and all information was accurate and up to date at that time. There is a Q&A at the end, but if you have any questions, please feel free to email us at askus@lgt-cpa.com, and we will get back to you as soon as possible.
Hey everybody, glad to have you back. Those of you that have attended some of our webinars in the past, for any of you who have not, we welcome you. I'm Colin Kanalakis, I'm a partner with Lane Gorman Trubitt. I've got a great team today. We're going to be talking about the PPP program, which I'm sure you're all very aware of. And then we will also be giving a tax update. I'll do a quick introduction and then I'll give you kind of more of the specifics of the agenda. I have Patrick Riley. He'll be starting this out. He's a dealership services partner for Lane Gorman Trubitt. Jay Krachek, she is a tax partner with a main focus on real estate developers. And then I have Denver Todd, tax senior manager with a heavy concentration in dealerships. We are Lane Gorman Trubitt, full service CPA firm based in Dallas, and we service clients throughout Texas, surrounding states, with a good footprint outside of the great state of Texas as well. We hope everybody's doing very well. Hope you're doing well with these different times, and by the number of you registered, I guess you're not too burnt out on all of these Zoom and Teams meetings that have become the norm, but we welcome you. So the agenda, we'll start out with PPP. We will go over the program at a very high level because we've gone into significant details in the past. We will go over some loan forgiveness recommendations. We will talk about the SBA forms 3509 and 3510s. We will talk over FTE considerations and recommendations. That's your full-time equivalent calculations. Those are some of the meatiest parts of the application process. Then we'll also talk about when to ultimately, or what happens when you receive notification of forgiveness and when you would record it. Now, one thing I touched on just briefly there, loan forgiveness recommendations. A lot of this is coming from, this will be gone over by Patrick primarily, and Patrick has been leading up our client and other relationship assistance on PPP application for forgiveness. So we're helping many of our clients either with the full calculation, including FTE and wage reduction calculations, as well as pulling together the data that you would end up ultimately putting into your application for forgiveness. In some cases, we're just advising and guiding and reviewing, but there's going to be some practical application and recommendations that come up from this. When this is over, we'll answer maybe a couple of questions in the Q&A. Key questions we'll answer before we kick off the tax update. In the tax update, we'll be going over the individual provisions, some business provisions, and then recent general tax provisions. And then, of course, we just had an election, and with elections come potential change, and I'll emphasize potential. So Shay will go over some of the proposed tax changes that are out there and what some of the impacts could be on you. Unfortunately, with these not being definitive and law yet, some of these are going to be pretty just more informative, so that you can consider with your advisor what kind of changes you should make, if any, before the end of the year or in 2021. We'll finish up with more Q&A if there's more questions that come up, and we'll be done probably by about 4:30 Central Time. So I'm going to turn this over to Patrick.
All right, thank you, Colin. Along with all of our programs, you'll notice there's a disclosure here the information that we're going to go over today. It's our typical disclosure. What we're going to start with is we're going to start a quick overview of the PPP program. I know a lot of you have kind of seen this already or gone through it, so we're going to go pretty quick through these sections. If you have any specific questions on these slides or anything in these slides on the PPP program in general, we do on our website have past webcasts that we have done that go into more detail for each of these. But we'll just kind of go through a quick overview here of the PPP program. When it first came out, it started with the option of 8 weeks of payroll and non-payroll expenses to be able to be forgiven. They've then pushed that over to 24. So now we have a longer cover period. So, what used to be 2.5 months of payroll and having 8 weeks to get that forgiven, to use those funds to be forgiven. They've then extended it out to 24. They've also reduced the payroll expenditure requirement from 75 to 60% of that information, of those funds can be used for the non-payroll. The Paycheck Protection Program, there's the opportunity to avoid FTE and salary reductions penalties if your headcount or wages are restored by December 31st. It used to be June 30th. They've extended that with increasing it from the 8 weeks to the 24 weeks. Some exceptions of that FTE reduction, if you return to the same level of the business activity as of February 15th, let me go back. If you do not have the ability to get to the same business activity that you did have at February 15th due to compliance with regulations established or guidance issued related to COVID-19, there's some specific language that helps you prevent having that FTE reduction. Some of the costs eligible for this forgiveness, essentially your payroll costs, your gross salaries, gross tips, gross commissions, any paid leave that's paid out to the employees for vacation, family, or sick time, for anything that is paid on the front end. Say you receive your funds on April 20th. From April 20th, that's any payrolls that you make from that day through the 24 weeks can be used in this calculation. You can also take a look at what has been incurred at the end of that 24-week period. And anything that has, if you have a payroll system that say is weekly from Monday to Friday, paid out that next Friday, and your covered period ends on October 24th, let's say, and that's a Friday, you might have one additional payroll that is paid the next Friday that you can include in your eligible cost due to that payroll being incurred during that covered period. It has set limitations on the cash compensation that or wage compensation that individual employees can get to the prorated of $100,000 a year. You'll note if you are an owner, that limitation is even less. It's capped at $20,833. Let's see, non-cash compensation that is eligible for forgiveness. This includes things like employer contributions to employee health insurance. That would be the employer paying the portion of employee health insurance for them. Employer contributions to employee retirement plans, and employer state and local tax that is paid by the employer. Overview, an additional overview of some of these non-payroll costs. If you have business mortgage interest, Those mortgage interest payments over those covered period can be included in your non-payroll costs to be calculated for forgiveness. If you have business rent or lease payments, the key is some of the new guidance that came out was that lease or rent payments need to be non-related. If it is a non-related entity that you are paying your rent or lease payments to, you can use the full amount over that covered period as part of your non-payroll costs. If it is a related party, you are then limited only to the mortgage interest that related party has paid on that property. Essentially, what they're trying to do is close some of those loopholes so you can't pay yourself rent just for the forgiveness part. One of the last items is utility payments, whether it's electricity, gas, water, transportation, which has always been pretty vague on their description of it, telephone, internet, any of those services that have been used over that covered period can qualify for your non-payroll costs. Let's see. These non-payroll costs, it's the same as what we talked about with the payroll costs, where they must be either incurred or paid or incurred, right? So if your covered period, once again, is April 20th, any gas or electric bills that you pay from that day through the end of the covered period, we know that those bills usually lag about a month. So you might have an additional month's worth of costs when that covered period is over that can be used towards those non-payroll costs. So, once again, a quick overview of how much of the loan will be forgiven. It all depends on how much is spent on payroll costs and non-payroll costs. Non-payroll costs are capped at 40% of the forgiveness amount. The forgiveness amount is reduced by if you have either a reduction in employer wages over that covered period of more than 25%, or if you have a reduction in the employee headcount or the full-time equivalent, full-time employee or FTE number. You'll see the FTE used throughout this presentation. That refers to a full-time employee. There's a number of different things that go into that calculation. We won't go into that now, but like I said before, if you have more questions on that, you can either reach out to us or we have prior webinars on our webpage that kind of go into how you should calculate those different calculations for there. If you receive an economic injury disaster loan from the government, a lot of our clients and a lot of our people that we've talked to have gotten both the PPP money and the EIDL money. The EIDL loan, if you have taken both out, the initial EIDL had a $10,000 advance. The way they've been recalculating these forgivenesses is that $10,000 is taken out as a reduction of your available forgiveness. So if you had a PPP loan of $1 million and an EIDL loan as well, that you got that $10,000 advance, the most you can get in your PPP forgiveness would be $990,000. You'd still have an outstanding loan of that $10,000. So the amount of forgiveness is calculated a number of ways, but essentially it's the lesser of total payroll costs and non-payroll costs, less salary or hourly wage reduction, multiplied by the FTE reduction quotient. Either that amount, the actual PPP loan amount, or the payroll cost divided by 60. That payroll cost divided by 60 is always a confusing calculation to people, but essentially what it does is it limits, when you put the calculation in, it gives you the proper breakdown of the 60% payroll, 40% non-payroll.
Good afternoon, everyone. When you are ready to submit your application, how it works is you have, once you submit it to the lender and the lender says you've submitted everything they need, you have, or the lender has 60 days to issue a decision to the SBA, and then the SBA has 90 days to review the application and issue a decision. And I have seen some borrowers that have received a complete forgiveness from the SBA. They'll send a little document that says they're forgiving everything. Or if they're not, they will mention that in there as well and stipulate the terms that you have to pay back the loan. And then the banker will also, or the lender that you're using will also should send you a letter on the decision that was made. If you do not apply for forgiveness within 10 months after the last of your covered period, the PPP loan's no longer deferred, so you're going to have to start paying principal and interest. When I was talking about, I have seen some loans that have been approved. I've only seen loans that were under $1 million. I haven't seen any of the ones over 2 million. I actually know of a few clients that have submitted over $2 million loans for forgiveness, and the SBA has actually come back to the lender and said, we need more information than you were required to, than the lender was required to obtain from the borrower, because that Schedule A worksheet where you list out the hours per employee, all that information, you don't have to submit that to the lender when they're reviewing the application, but the SBA can come back and request it. And for the big loans, the SBA has come back and requested that information. They're reviewing it. So it's important to make sure you have all the information ready to go in case you have to provide it. Next slide, please. Okay, so one of the big questions was, are these PPP funded expenses deductible? So back in April 30th, there was a notice that came out and said no, because in the original CARES Act that was signed in legislation, the language stated that when the loan is forgiven, it is going to be tax exempt income. So at first, a lot of people were wondering what happens to the expenses. Are they going to be deductible or not? The IRS has come out and said no, they're not going to be deductible. And then the big question came as to timing, because a lot of people, or a lot of borrowers, have not submitted their application for forgiveness, or they have submitted it recently and they don't expect a decision on their loan until 2021. So what happens to the expenses? Because on anyone's financials right now that received a PPP loan, they've most likely deducted all the expenses that they paid out that were funded by the PPP loan, and the loan's still sitting on the balance sheet as a loan payable. So what happens in this situation if that loan payable is still out there at the end of 2020 and you don't have a decision? Well, the IRS on November 18th came out and addressed this situation. Next slide, please. And this is a statement from the Treasury, and then I'll go in more what and correction, they didn't issue a notice, they actually issued a revenue ruling, which is higher authority than a IRS notice. So what the Treasury statement said, if a business reasonably believes that a PPP loan will be forgiven in the future, expenses related to the loan are not deductible, whether the business has filed for forgiveness or not. Therefore, we encourage businesses to file for forgiveness as soon as possible. So next slide, please. Okay, so in the revenue ruling, there's two situations that the ruling discussed. So in the first situation, you had a taxpayer that received a PPP loan in 2020, and they pay the eligible PPP funded expenses in 2020. The taxpayer applies for forgiveness of the PPP loan, and they knew the amount of the expenses that qualify in November 2020, but they had not been informed by the lender at the end of 2020 whether the loan would be forgiven. In that first scenario, the IRS has come out with a revenue ruling is saying is you can't deduct the expenses even though you're not going to get the decision until 2021. Situation two, the taxpayer has not applied for loan forgiveness by the end of 2020, but knew the amount of expenses that qualifies. So in the same situation, the IRS is stating that you cannot deduct the expenses in 2020 if you know what your forgiveness amount is going to be in 2021. Now, there is a little gray area because there could be some borrowers that have no idea what their forgiveness is going to be. And if you're in that situation, if you haven't analyzed it at all, definitely reach out to your CPA. That's a little bit more of a gray area, but I think most practitioners will probably be conservative and not deduct the expenses until a decision is received from the SBA. And then at the bottom, the IRS says in both situations, the taxpayer has a reasonable expectation of reimbursement in the form of loan forgiveness at the end of 2020. Therefore, the deduction of expenses is inappropriate. Okay, so next slide, please. At the same time that revenue ruling was issued on November 18th, there was a revenue procedure issued or released as well, and it provided a safe harbor. Because what happens if you you haven't filed your tax return? Because remember, the 2020 tax year is almost over, but the due date for the tax filing for the 2020 return is not going to be until March 15th if you're a flow-through entity, which would be a S Corp or a partnership. And then April 15th if you're a C Corp or a sole proprietor. So there's still a few months you have until your tax return is going to be filed. And if you're in a situation where you the IRS has come out and said your expenses that you incurred for in 2020 are not deductible, and you think your loan's going to be fully forgiven, but then when you go into 2021, you get notice from the SBA that your loan is not fully forgiven. Maybe a part of it's not forgiven, or maybe the entire loan is not forgiven. In that case, the IRS has issued the safe harbor where they are essentially saying those expenses that we said you cannot deduct in 2020, now that you have a decision that differs from what you expected when you received it in 2021, you can make the decision to when you want to deduct those denied expenses. So you can deduct them on your 2020 tax return. You can go back and amend your 2020 tax return if you've already filed it by the time you receive the decision, or you can decide to deduct those expenses in a future year, 2021 or 2022, whenever that occurs. The only reason you might want to, if you were in that situation, to possibly take use number 3 down here is if the tax rates went up for 2021, you'd want to take the deduction at a higher tax rate, but it just depends what situation you're in. And then if you are going to use the safe harbor to go back and deduct expenses, then you must attach a statement to your return regarding this as well. But definitely reach out to your CPA if you think you're going to be in this situation. And then I will pass it back to Patrick.
All right. Thank you, Denver. So now we're kind of going to talk a little bit more about some of the recommendations we kind of have when you're applying for forgiveness here with the different loans. Um, One of the, we've been doing these for a number of clients now, and we've kind of taken the philosophy that if you can get full forgiveness on just payroll, do that. I think, sorry, as my video goes on, as we now, they're giving us 24 weeks of payroll to use on a loan that's based on 2.5 months of payroll. If you can get that full loan forgiveness based just on payroll, that's our recommendation for you. It allows you to not have to worry about submitting invoices for your phone system, your related party mortgage interest, your gas bill. And if you cover the payroll, all you have to do essentially is to submit your payroll register. Sure, you still have to go through and do the calculations for the FTE and any payroll reduction you might have, but the amount of information that you have to submit to the bank is a lot smaller. When we're talking about some of these bigger loans, do we really need to be chasing down a $500 phone bill? Now, if we're getting to the point where we need to tie those down to get full forgiveness, then yes, please do. But I think if we can do it just on payroll, that's kind of the best advice we have right now. Let me go to the next one. When you use it just for payroll, it can't be questioned that what you use these funds for is what ultimately Congress intended it for. They intended these funds for companies for paying their employees, for keeping their employees on staff. So this might help your case if the SBA ever comes back with the need question, right? We've seen that a little bit, and it'll be addressed later in this presentation. But as these loans came out, now the SBA and other people are talking a little bit more of what was the need that you had. Well, at the time these came out, no one knew what was going on. We were in the middle of a pandemic. We had other countries in Europe completely closing down their economy, their companies. We had talk of that happening in the US. We didn't know how long this would last. We still don't. So there was a great uncertainty there. And these loans were meant to keep our employees and to pay payroll. If you can show that that's exactly what you used them for, I think that would better your case if it would ever came up. We also talked about, I saw a question there on, if say, do you have to use the full 24 weeks? Say you reached full forgiveness in 14 weeks. That seems to depend on the bank. One of the things we've done is just use the 24 weeks. We're at a period now where that 24-week period is up for most people that have applied for round 1 or 2. So if you have the information, you might as well use it. And it also helps build a buffer there in case you do have any possible FTE reductions or payroll reductions. An example of that is, say you have $500,000 in an SBA loan that you took out. Well, now if you use that full 24 weeks, maybe you have $1 million of eligible payroll. You can still get full forgiveness if, say, you had a decrease in your FTE numbers, or you had a payroll reduction that caused either the payroll reduction of 25,000 in this case, or an FTE reduction of 20%. Well, at 80% of $1 million less 25 of that payroll reduction, you're still over the $500,000 that the loan was for. and that would still get you that full forgiveness. To continue that on the payroll side, I would just use the available forgiveness expenses. If you can't get to the full forgiveness just on that payroll, I would kind of then start using the payroll related expenses. You could use the expenses that kind of help benefit your employees, right? Whether it's the state or local taxes, if your company made any 401 contributions for your employees' benefit, if the employer is paying some healthcare expenses for the employee, essentially it kind of goes into that whole period of what is this loan really for, right? I don't think when they made the loan, they thought that, you know, these companies would benefit from having this free money, right? So this kind of helps build that story for you. If you're ever questioned by the bank or the SBA on what you use those funds for, or we also know that over a certain amount, your loan is public knowledge, you can show that it was used for these employee benefits, whether it be wages or these other expenses for the employers. Now, if you still can't get to that, then we start using the items like rent, utilities, transportation, items like that to help try and get you to that full forgiveness amount. Recently, and kind of going back to the SBA pushback, recently for loans over $2 million, the SBA has sent out these necessity questionnaires. These questionnaires go into a lot of detail on the revenue that the company had before the loans, since the loans, any capital expenditures they had during that time, the owner's pay, and a bunch of other in-depth questions there. They say it's just for their knowledge. It's not sure how they're going to use these forms quite yet. One of the key takeaways, though, is if you get these forms from your bank when you're submitting your forgiveness application, I would talk with the bank and note that these are still in draft form. They are not final regulations that need to be filled out. They're open to change, and a number of organizations are pushing back on these, including the AICPA. I know the NADA for the National Auto Dealers Association, and a lot of other national organizations and lobbyists are really pushing back on the need for the company to disclose all this information when that was not the purpose of these loans. So talk to your banker and push back if you feel like you really don't want to share all that information, because as of right now, you don't need to. There might be more regulations that come out and it might go into a final form, but as of now, it's still draft and subject to change. From the Journal of Accountancy, one of the articles I read, it said the AICPA is among 82 organizations that have signed onto a pair of letters expressing concern about the new Payback Protection Program loan necessity questionnaires, which require PPP loan borrowers with loans of $2 million or more to complete a new form and provide extensive documentation supporting their request for relief funds. The coalition, which represents millions of American workers and small businesses, suggested that the existing PPP forgiveness application, specifically SBA forms 3508 and 3508EZ and 3508S, should continue to be used because they allow the agencies to examine in great detail and prior to the approval of loan forgiveness, relevant facts to ensure that the PPP loan funds were used in the way Congress intended. I know that was a mouthful. I hope we didn't lose anyone halfway through that, but essentially their argument is kind of what I proposed before is when these first came out, no one knew. There was without a doubt uncertainty of your business and what is the future of your business with with this pandemic. And the funds were for you to make the decision to keep paying your employees rather than getting out a loan, right? They talk about the available of funds. No, very few business people will take out an additional loan just to keep the workforce that they're not sure they really need. So this is where these PPP funds came through. When you're calculating your FTE, your full-time employee recommendations, what happens if you don't? One of the things we've seen is what if you don't have timesheets for your employees? First of all, if you don't have timesheets for your employees or your employees aren't fully keeping track of their time in detail, we do recommend that you speak with an employment lawyer to understand your risks and possible any mitigation strategies you can install to help that. But while you're going through there, if you have salaried employees where company expectations are they are full-time, but they don't necessarily have a timesheet, you can count them as one full-time employee for the time period that they were paid, for that pay period that they were paid. If you have commissioned employees, or sometimes in the dealership world, you'll have your techs or salespeople that don't necessarily keep a time because they're on a commission basis. One of the ways you can use is a simplified FTE approach. And for each pay period, you would just count them as a 0.5 or essentially less than 40 hours a week. I know you worry that, oh, this is going to decrease my FTE numbers and cause more of a risk that I might have an FTE reduction. But you have to compare apples to apples. So if you're counting your commissioned employees as 0.5 during the covered period, you need to count them as 0.5 for the other detailed comparative periods that go into that FTE reduction calculation. Make sure the method is consistent across each of your calculated FTE periods. If you're going to use kind of what I said just before, if you're going to use all commission people as 0.5, do that for your calculation of the covered period and the period from February 15th, 19 to June 30th, 19. Or January 1st, 20 to February 29th, 20. Those are the two covered periods that are on the application that go into that FTE reduction calculation. So Denver talked about the income tax deductibility of these PPP loans. The question is book purposes. How do we record these loans? And the forgiveness of the loans, and essentially when, because we're coming here at the end of the year where if you haven't submitted already by the bank, there's a good chance that you won't get approval from them before year end. If you've done it in the last month or so, it's kind of hit or miss or when you're going to get that approval from the bank, and then it goes up to the SBA depending on the size. So if you are a non-for-profit or deal with grants on a regular basis, you have the option to record these SBA loans as if they were a grant, and you can use your grant revenue recognition procedure to record the income when the expenses are paid. That sounds lovely, and I think we'd all like that, but it specifically says only if you are a not-for-profit or on a regular basis deal with grants. If you are not, then you record the loan as your typical loan as a liability on your books. If it's under that $2 million threshold, the amount that is forgiven can be taken as income once the forgiveness is approved by the lender or the bank, and submit it on to the SBA. That is over that $2 million threshold, that amount is to be forgiven and can be taken to income once the forgiveness is approved by the SBA. So there's that second line of approval that's needed if your loan is over that $2 million, mainly because that $2 million is the threshold that the SBA has come out for their audit limit. Finally, oh no, that is all I had right now, but we will open it up for a couple of questions as they come in. Colin, have you been working through this?
Yes, I have got a couple.
Okay.
And again, we are trying to answer a few of the questions in the Q&A. Be aware that when you type your question in, it's in open. When we answer the questions, it's in the answered. So make sure you look in the answered instead of post your questions a couple times. All right, there were 3 questions that we thought we could address. It's really 2 are related to each other. So the first one I'll ask is, if you're doing the 24-week payroll period and your payroll, you only need enough payroll to get you up to if by week 14 you had adequate enough payroll to cover the loan forgiveness, can I stop there, or do you have to keep going to get to the full 24 weeks? And this can be a question that Patrick or Denver would like to answer.
Yeah, it seems to depend on the bank. We're finding that some of these banks are not as sophisticated as we hoped when it comes to figuring out what they're going to do to approve these forgiveness applications. You know, as we've been doing the calculations for some of our clients, the information, if you're just doing payroll, has been fairly easy to obtain and to calculate. And then when you ask for forgiveness on, you know, $1 million loan and you could show $2 million of payroll, I think the approval has been quicker. Now, if you don't want to go through that and you want to do it as 14 weeks, I think you could probably push and do it over the 14-week period.
All right, that sounds great. I would agree with that fully. Sorry guys, you're starting to load up questions in the Q&A, which is great. I appreciate that. I'm gonna keep my head down and focus on these questions. We will keep answering questions, and then we'll have some more time for Q&A at the end. So if there's any other questions that come up that we think would be worth talking about as a group, we're going to keep that going. So make sure you stay on and listen to Shay, because we'll be back to talk more PPP. All right, the next one.
I think one of my big things we've just been harping on is you can do it in payroll, do it in payroll. They've extended the dates to that 24-week period, that unless there is significant disruptions in your business, you should be able to get the full forgiveness with your payroll. And it just makes it easier to, when you submit to the bank, you'll have your FTE reduction calculation, your payroll reduction calculation, your gross wages, and your check register, your payroll register, and you're done. Instead of trying to figure out, 60-40% of non-payroll payroll.
All right,
So
let me address one more question that's asked, just because it's been asked a few times, and I know this has been covered kind of high level in the presentation, but a 2-part question, which is when is and I'll go ahead and answer it as well, but when is the taxable income incurred? So if, for example, many lenders haven't necessarily even opened their portals. So what does that mean? You can't apply right now. And so we've had, some people who've been able to apply, some have been able to get forgiveness. So what happens is that you will record book income when it's been forgiven, but the effect for tax purposes, based upon the law that's written right now, is that the expenses will be lost within the 2020 tax return that's filed. Now, since we're all hopeful and Congress has said that they intended that this would be non-taxable, this could be a year of extending your returns. It doesn't mean you have to extend. I mean, we have many clients that don't like to extend. So what you would have to do is you'd have to do your year-end tax estimates based upon losing the deductions that went into it. So that would be mainly your payroll type deductions on your business returns, and then therefore your individuals and other tax paying entities, if your entity itself is a flow through entity like most are, they would pay, you would ultimately pay more in. Now, if you extend and ultimately the law changes and it becomes non-taxable, great. It just means you paid too much in. You can decide you want to go ahead and get that refund or apply it to the next year. If you go ahead and file, which is perfectly fine, then you'd file, and then if the rules changed, then your returns would ultimately get amended, and you would take that same position. Let's see, I think that covers it. So if, for example, your loan got forgiven and is not forgiven by the end of this year, it's forgiven in 2021, you would record it as income. So on your books, there's different ways to record it. Many cases it's recorded kind of below the line as like an other income type item. In some cases, it's recorded more as a tax return type entry where it's taken into income on the tax return, and then in 2021 it goes back to retained earnings. I have had a few clients that what they've asked is, look, if we paid people more, like, you know, we paid them more than they really earned as part of the work that they were performing, and we'd like to make ourselves whole, especially from a compensation bonus or commission type threshold. Can we take some of that forgiveness as a reduction of those underlying expenses? And that makes complete sense as long as you're comfortable with what the effect is on bonuses and commission, et cetera. That's really your goal. So there's no defined way of how it needs to be recorded. There's many different ways. So talk with your advisor and we'll happily talk through it with you and help you determine what best works on your end. I'm going to go ahead and turn this over to Shay to get started on the tax update, and then we'll see you all again at the end.
Hello, everyone. Sorry, I was trying to get all the technology set up. Technology is not my strongest suit. I'm going to do a brief 2020 tax update for individuals and businesses, and then kind of talk about some of those provisions that were released this year due to coronavirus, as well as, you know, other ones out there. And then we'll look at 2021. It's still very up in the air, but we'll do our best to give you some level of comfort. So first we'll talk about individuals. Once again, for 2020, the highest tax rate is 37%. And that 37% will kick in if you're single at $518,400, if you're married at $622,050. The capital gains and qualified dividend rates still range from 0 to 20%. That 0% you get on taxable income up to $40,000 single, $80,000 married. And the 20% kicks in at $441,451 if you're single, and $496,601 if you're married filing joint. If you're in between those ranges, you'll get the 15% rate on capital gains and qualified dividends. Of course, we still have the additional Medicare tax. This was from the Affordable Care Act, and it's 0.9% on wages for any income exceeding $200,000 if you're single, and $250,000 if you're married. And we also have the net investment income tax. This affects your investment income, so it kind of increases those capital gain rates I mentioned above, and that is 3.8%, and that kicks in with that same range, excuse me, $200,000 if you're single and $250,000 if you're a joint filer. Individuals also still have the alternative minimum tax that ranges from 26 to 28%. The exemptions for 2020 is $72,900 if you're single, $113,400 if you're joint filing. I'm sorry for throwing all of these numbers out here. That's probably the tax nerd in me. Standard deductions are $12,400 for single and married filing separate filers, and $24,800 for joint filers. You can go along with the itemized deductions. So if your deductions are higher than those standard deductions amount, you would take those. Some sneak peeks on those for medical expenses. The threshold is 7.5% of your adjusted gross income. And the state and local taxes are still capped at 10,000. And that's for property taxes and state and local income taxes. I know that can be very frustrating, but here we are. Charitable contributions, I'm going to discuss them later because the CARE Act did add a little perk, but in general, your limitations are 30 to 60%. There's some options later on that I'll talk about where it's 100%. Also, this year you can use your health savings account, your flex spending account, and any health reimbursement account to buy over-the-counter medicines without a prescription. I know that was taken away, but the CARES Act did allow that. And then this year also for your health savings account, the contributions are $3,550 for single plans and $7,100 for family plans. So next I'll talk about retirement distributions. We'll mention the Secure Act later, but it did have some changes. The required minimum distribution age increased from 70.5 to 72. And this is only for account owners who turned 70.5 after 2019. So if you're already at that age, then you're still required to take that distribution. They've also now allowed contributions past the age of 70.5 to IRAs. Historically, that was not allowed. And then they added a new exception for that 10% early withdrawal penalty. You can use up to $5,000 for having a new child or adopting a new child. I'll kind of go into detail later about how that looks. And once again, you can do qualified charitable distributions up to $100,000. And those distributions go directly from your plan to the qualifying charitable organization, and whatever you distribute out to the charity is not taxable income, but you also don't get the charitable contribution deduction as well. If you are contributing, you've reached past that age of 70.5 and you are still making contributions to your IRA, there is some play between that and the qualified charitable distribution. You're not going to get that same double benefit on that. Estate and gift tax exemptions. For 2020, it's 11.58 million. If you're a married couple that's elected portability, it's 23.16 million, and your tax rate is still at 40%. The gift tax exclusion also did not change, and it's the same for 2020 and 2021. It's 15,000. The standard mileage rate is 57.5 cents for businesses. And the qualified business income deduction is still around. If you recall, that was brought out to decrease the differentiation between what the corporations were paying with that reduced 21% rate and what the partners and shareholders are paying. So if it's a qualifying business, you can get 20% deduction for it. If your business qualifies as a self-employed, you get it for your self-employed business, but also owners of pass-through entities. As I mentioned, not all business types qualify. Service industries typically do not. But if your taxable income falls below a certain threshold, then you do get to take that 20% without taking into account any of those limitations. For 20, the threshold is $163,300 for single and $326,600 for married filing joint. We still have the loss limitations. The excess business losses was $259,000 for single, $518,000 for married filing joint. I'm going to touch on that more in the CARES Act. And also, I always like to mention the other loss limitations. You know, sometimes at tax time, your losses are limited and you don't understand why. There's several different reasons. It could be the excess business loss. It could be a passive activity loss. You can only take those losses against any passive income or until that activity is disposed. So if your only passive activity is that loss and you have no other activity that creates income, you can't take that loss until the income is generated. There's also basis limitations. Kind of generalize that. You pretty much cannot take a loss for more than what you've put into the deal. And then at-risk limitations determines the amount you're at risk, and then that loss could also be limited. So all of these work together. It's a super fun calculation. And that is individual provisions. I'm going to go ahead and start talking about business updates. I know there's much more with individuals, but I want to make sure we have plenty of time, and always we're available for questions afterwards as well. So once again, the corporate tax rate is 21%, and the qualified business income deduction I mentioned earlier is that 20% if it qualifies. The alternative minimum tax, it was repealed for corporations, and then the CARES Act does allow for kind of an accelerated refund of that minimum tax credit. We'll mention that later. Business interest expense. I tried to keep this as small as possible. It's an 11-step calculation. So as I mentioned, the business interest expense, they've added this limitation that it cannot exceed the sum of business income, 30% of the taxpayer's adjusted taxable income, and any floor plan financing interest, if that's applicable for the year. If it does exceed that amount, then you have to carry that over and disallow the interest. Adjusted taxable income for this purpose is taxable income without regard to depreciation, amortization, or depletion, but that is only through January 1st, 22. After that, you will include those amounts in it. And then if your business is subjected to this, again, it's an 11-step calculation, and it's carried over or included in the basis upon disposal. There is a small business exception for this, and that is also for other accounting methods, but for this purpose, it's your average 3-year gross receipts for the immediately preceding 3 years is less than 26 million, and you are not a tax shelter, you are not subject to this limitation. The tax shelter can catch a lot of partnership returns, so to make them subject to this calculation. The CARES Act did increase the deductibility to 50% for tax years 2019 and 2020. But for partnerships, they can actually only use the 50% for 2020, so they had to use 30% for 2019. They did say if there's an excess business interest expense, and that's interest that it was limited in 2019, then 50% of that interest is treated as paid or accrued to the partner in 2020. And that interest is not subject to the limitation at the level of the partner. The remaining 50% is subject to those limitations. In addition, if the partner disposes of its interest in 2019 or 20, that business interest expense is deductible, while historically you would include that in as additional basis. Now they're saying you can deduct that interest. Certain industries can actually elect out of this calculation. Certain farming industries and real estate industries can elect out. If they do elect out, they have to use the alternative depreciation system, which makes them ineligible to take bonus. We'll talk about bonus in a little bit, but that allows you to write off 100% of the cost of qualifying asset purchases in the year it was acquired. So if you elect out of the business interest expense limitation, then you cannot take bonus depreciation, and you have to use that alternative depreciation. They also, under the final regs which were released, they did say if interest is coming from an exempt partnership or S corporation, so they were not subject to that interest expense calculation at that partnership or S corporation level, then it's not going to be subject to the limitation at the partner and shareholder level. So before you had to do the calculation, if they were exempt there, you still had to do the calculation at that partner level, and now they're saying you do not. They've also allowed for business to elect to use the 2019 taxable income for your 2020 tax year. So if you're 2020, it's been a crazy year for everybody. If your business had a loss or not as much income, and so your interest would be limited more, and you can elect to use 2019 for 2020 to try to free up some of that interest. So that is the short version for business interest expense. Again, we are always available for questions on that. So entertainment and meal expenditures, those did not change. Entertainment expenses are still 100% non-deductible. So it's pretty much any activity that can be considered to be entertainment or with respect to facilities used in connection to entertainment. And that includes dues or fees to like country clubs, bars, theaters, hunting, fishing, etc. Sometimes I like to say anything that's fun is probably going to be non-deductible. They do allow, say if you purchase a suite and at a sporting event and you bring, your clients or business associates, and there is food and beverage, if you have the venue break out that food and beverage cost separate from the entertainment cost, you can get the 50% meal deduction on that food and beverage. The entertainment will still be non-deductible. If you don't have them break that out and they just give you an invoice with that one lump sum, then the whole thing will be considered entertainment and it will not be deductible. In most cases, meals are still 50% deductible. It has to be for a business purpose and with a business associate. It is 100% deductible if it's for your employees and you include it in their compensation. You can go ahead and 100% deduct that. And then also any kind of company-wide party. So right now, in a non-COVID-19 year, you'd probably be having a holiday party and renting out a venue for that. That is also 100% deductible for that. So that's the brief snip on meals and entertainment. Depreciation. As I mentioned, bonus depreciation is still 100% through 12/31/22. And this is for any qualifying equipment purchase, furniture, fixtures, qualified improvement property. When the year you purchase it, you can write that off 100%. There's not an income limitation on bonus. If, for example, in 2020, your numbers are low and you do not want to take the bonus depreciation, you can elect out. Just know it's an all election, so you can't pick and choose and say, I want to take bonus on this piece of equipment, but not on this other piece of equipment. If you elect out, it's for all of your equipment that year. There's also the Section 179 option. You can write off up to $1,040,000 of equipment purchased. Once your equipment purchases rise over that $2,590,000, it will start to be limited. Section 179 does have a net income limitation, so it can't drive you into a loss, and any disallowed would be carried forward. I mentioned briefly the qualified improvement property, doing a lot of real estate. It was very exciting to me when I saw the CARES Act fix this technical correction. When it first came out with the Tax Cut and Jobs Act, Congress had written qualified improvement property as 39-year property, and everyone knew they really meant for it to be 15-year property. It was just probably quickly drafted. But by doing the 39-year property, we were unable to take bonus depreciation on any of those interior improvements to non-residential property. You had to treat it as 39 and write it off 39 years. They did fix that with the CARES Act, and you can take the 15-year property deduction as well as write it off as 100% bonus. And they did retroactively apply this for 2018 and 2019. And so if you had any qualified improvement property that we did the 39-year, we can't go back and correct that for 2018 and 2019. Once again, like-kind exchanges are only allowed for real property. You can no longer do it with equipment or automobiles. And then I did want to briefly mention the casualty losses. In addition to COVID-19, it's been quite the year for hurricanes. And for personal, I didn't put this up in the individual. For a personal casualty loss, it must be a federally declared disaster area to be able to take that. For a business, usually you have, a couple of years to work on replacing and repairing that property, but there are some options there. As I mentioned earlier, there are small business exceptions to various accounting methods. So for taxpayers, that average annual gross receipts for the 3-year taxable period ending with the year preceding the current tax year does not exceed $26 million, and that $26 million is for 2019 2020 and 21, then you are able to use the cash method of accounting. You don't have to do the UNICAP Section 263A accounting for inventory. You can do specific inventory accounting rules. The business interest expense limitation, as I mentioned earlier, you are not required to do that, and you do not have to do the percentage of completion method on long-term contracts. Again, if you're a tax shelter, you do not get this exemption. All right, so that was businesses. And now I'm going to talk about some of the recent tax provisions that have come out due to various disasters and COVID-19. The first was the Taxpayer Certainty and Disaster Relief Act. And these were for those affected by disasters in 2018 through 1/19/20. Obviously, there were more disasters this year, so we'll see if that changes. There's cancellation of mortgage debt. Individuals can exclude up to $2 million of cancellation of debt income if it's canceled due to a taxpayer's financial condition or decline in the value of residence. This is available for 2018 through 2020. For the medical itemized, they decreased the threshold from 10% to 7.5% of AGI. This is for 19 and 20. For mortgage insurance premium deductions, if your adjusted gross income is less than $109,000, you can treat that as mortgage interest expense. And that is for 2018 through 2020. Tuition and fees deduction, you get an above the line deduction for up to $4,000. That also has some income thresholds that you have to fall below to be able to utilize that. That is for 2018 through 2020. There's the personal energy property credit. This is qualified energy efficiency improvements to your principal residence. It's a $500 max. A lot of people may have already utilized this. If you didn't know about it, let your tax advisor know, because you can utilize that for 2018 through 2020. There's also many other disaster relief provisions. You can use up to $100,000 of retirement funds for disaster related matters and avoid that 10% penalty. There is actually an employee retention credit for employers affected by the qualified disasters. They reduced and suspended some limitations on charitable contributions associated with disaster relief, personal casualty loss limitations, and the earned income credit calculations. And they also extended various other credits. And then the work opportunity credit was also extended through 2020. Next up is the Setting Every Community Up for Retirement Enhancement Act. What would we do without acronyms? I don't know. So it's the SECURE Act. I mentioned a lot of these briefly, so I'll go through this fairly quickly. Again, they repealed that maximum age for IRA contributions. So if you're post 70 and a half, then you can contribute your IRA. And just remember, you have to track the IRA contributions. And then if you do any qualified charitable distributions, you have to keep track of those, so you don't get that double tax benefit. The required minimum distribution age increased to 72. The post-death RMD rules changed. So if an owner dies after 12/31/19, the remaining balance must be distributed within 10 years. And now you can use Section 529 plan distributions for apprenticeships and to repay student loans of the beneficiary. You cannot receive more than $10,000 in a lifetime for student loan distributions. So that'll put a very small dent in it, most likely. They repealed the kiddie tax changes that were enacted by the Tax Cut and Jobs Act. They were charging the trust and estate rates, which I didn't go into here, but they're extremely unfriendly. And now that you can use the parents' rate once again on that net unearned income. Again, they added that new exception for withdrawals for birth or adoption of a child. Each parent can withdraw up to $5,000, and this is for post 12/31/19. And it must the only rule is it must be made during the 1-year period beginning on the date of birth or legal adoption is finalized. So you could get up to $10,000 if each parents go for it. The small employer automatic enrollment credit for certain retirement plans, you get a $500 credit for new small employer plans that automatically enroll. There's the increase in credit for small employer pension plan startup cost. It's the greater of 500 or the lesser of 250 for each employee who is not highly compensated. And then they also added 401k plans must expand coverage for long-term part-time employees. That is an employee who has at least 500 hours of service in 3 consecutive 12-month periods and is at least 21 by the end of the last period. They must be allowed to participate and make elective deferrals in that 401k plan. All right, the Family First Coronavirus Response Act. Again, if you go to our COVID-19 resource page, it can go into more detail on these. I'll try to be as brief as possible. There's the emergency paid sick leave. So if you have less than 500 employees, you must provide 80 hours of paid sick leave to employees who are unable to work for virus-related reasons. If it's directly virus-related, the pay is up to $511 per day with a $5,110 overall limit. Again, they have to be directly affected by the virus. Or it's $200 per day with a $2,000 overall limit for an employee that is a caregiver for someone with the virus. If you have less than 50 employees, you can kind of get an administrative exemption, but you have to show that only if, implementing this or doing this requirement would jeopardize the viability of your business. And these are for wages from April 1st, 20 through the end of the year, 12/31/20. There's the emergency family and medical leave. That again, that's for less than 500 employees. You must provide both paid and unpaid leave. And it's available when an employee must take off to care for the employee's child under 18 due to COVID-19 emergency that either closes the school or makes a child care provider unavailable. The first 10 days of leave can be unpaid, but then paid leave is required. You cannot exceed 200 per day and 10,000 in the aggregate per employee. This is also for wages from April 1st through the end of the year. If you're self-employed, you can also do the emergency paid sick leave and the emergency family and medical leave. It has the same max, 5,110 or 2,000 if you're directly affected or being a caregiver for the sick leave, or 10,000 if it's for a family and medical leave. But you can only take that to the extent that the self-employed person has, let me repeat that. It's decreased by the extent that the self-employed person has insufficient self-employment income or received paid sick leave from an employer or paid leave from an employer. Now, if you provided this, you do get credits for these. For most employers, it'd be on your payroll reports. The credit is for the emergency paid sick leave is the same. It's 500. It caps out at 511 per day or 5,110 max, or 200 per day, 2,000. But you can also increase that credit if there were expenses provided in connection with a qualified health plan, if the expenses are excludable from that employee's income. And you can also add in the employer's share of the payroll Medicare hospital tax on that. And the credit is against your 6.2% Social Security payroll tax. And the credit, if it's in excess of the Social Security tax, is refundable. It's the same for the family and medical leave. You cannot use the same wages for the sick leave and the family medical leave for these credits, because then you're getting a double tax benefit. And again, these are all for wages from April 1st, 20 through 12/31/20. All right, the CARES Act. Again, you recall the recovery rebates. If qualified, everyone got a $1,200 check, increased by $500 for each qualifying child, and then it was reduced once you were over that income. There will probably not be a second round of these. Everywhere I've heard is that do not expect another one. Also, the CARES Act provided for exclusion for employer payments of student loans. They can exclude up to $5,250 from income for benefits from an employer-sponsored educational assistance program or the payment of student loan debt. And these payments must have been made before January 1st, 21. They waived the required minimum distribution requirement for 2020. And this includes distributions that were required on April 1st due to the taxpayer turning 70.5 in 2019. If it's still, I know it's almost to the end of the year, but if you have, automatic distributions and they haven't occurred yet, you may want to contact your administrator, because it may process even though it's not required. So if you don't want it, you don't have to take it. They waived the 10% early distribution penalty. It must be coronavirus related distribution, and you can take up to 100,000 out of your retirement account. And when you pick up that income, you can spread that over a 3-year tax period. And then you can also contribute it back in that same 3-year period and reduce the taxable income you have to pick up. And these are for distributions made from January 1st through the end of the year. And some administrators will request that you self-certify that it is a coronavirus related distribution. They added the 300 above the line charitable deduction. This is across the board, regardless of filing status. So if you do use the standard deduction and do not itemize, you can take $300 above the line. And then also on charitable contributions, if you do cash contributions in 2020, you can get, there's no limitation. You can contribute up to 100% of your adjusted gross income. Again, it's cash only that applies for that. And then donations to donor advised funds generally do not qualify under that. So if you have any questions about donations, we still have time. If you're expecting a good year, you can knock down some of that with charitable contributions. Corporations, they increase the limit to 25% of taxable income from 10. And then you can also, they increase the limit, you can then do a food inventory as well. So the employee retention credit, we had talked about this on our COVID-19 resource page. So if you want more detail, but it's pretty much a refundable credit against the employer's 6.2% of Social Security payroll tax for 50% of certain wages paid to employees during that crisis. They have to show they were partially or fully suspended as a result of a government order, or they have to pass a gross receipts test showing that their receipts dropped at least 50%, and they compare quarter in the prior year and quarter in the current year. If you have more than 100 employees, the eligible wages that qualify for this are only for those employees who were furloughed or can't provide, or hours were reduced. If you have less than 100 employees, all employees are eligible, and the cap on that is 10,000 per employee. But you only get 50%, so it's really 5,000 per employee. And you cannot take into account any wages paid under those emergency sick leave or the Family Medical Leave Act. And then it's not available if you received a PPP loan. They repealed the disallowance of carrying net operating losses back. You can carry back losses created in 2019 and 2020, 5 years. They took off that, they took off the 80% limitation for 20 loans for net operating losses. So they had it, if the loan was created after 2017, you could only use up to 80% of taxable income to offset that net operating loss. And they took that away. So you can use your full net operating loss against all of taxable income, and there's no limitation. Deferred employer payroll taxes. So all of 2020, you can defer in 2 equal installments and pay those back in 21 and 22. It's not available if you have debt forgiveness under the CARES Act. If you're self-employed, you can do 50% of your self-employment contributions. And this is for wages after 3/27/20. And this is only the employer portion. Again, they did that technical correction for qualified improvement property. You can delay funding your pension plan. The new due date would be January 1st, 21. Sorry, I'm trying to go quickly so we have time for questions. The corporate minimum tax, I mentioned this earlier, you can claim 100% of those credits in 18 and 19, but it must be filed by 12/31/20. Business interest expense, again, they increased that to 50%. And then that business, excess business loss, you can deduct those losses for 18, 19, and 20 in farmers through 2025. The limitation was modified for that. And then I won't go into the SBA loans that were part of the CARES Act. Okay, I'm sorry I did that really quickly, but I want to make sure we have time for questions. All right, a 2021 sneak peek. Again, this is what we know of the current this is versus our current administration and what the proposed one is. It could definitely change. It could not happen at all. But I wanted to give you guys a sneak peek. So under the proposed administration, the highest tax rate would be 39.6, and that's for taxable income over 400,000. Currently, our highest rate is 37%, and that's in 21 would be over a taxable income of 523,600. The biggest thing, well, I'll go ahead and mention corporate tax rates that might jump up to 28%. But to me, the biggest thing is capital gains and qualified dividends. Under the proposed administration, if your taxable, if your, excuse me, if your taxable income goes over that 1 million, you could be paying the highest rate, 39.6. And that does not include the net investment income tax of 3.8. So you're really paying 43.4% on capital gains and qualified dividends once you're over that threshold. For our current administration, once you're over 445,000, you pay 20% or 23.8, including that net investment income tax. Itemized deductions are currently not limited. They're going to add back that 3% limitation once you get income over 400,000. The state and local tax is currently capped at 10,000. That would be removed. That is the proposed, is to be removed. Carried interest would be eliminated under the proposed administration. Payroll tax for Social Security, it caps at that 142,800. Under the proposed administration, once earnings are over that 400,000, there'd be an additional, the additional 12.4% tax on that. So there's kind of a window where it's not, and then when you get over that 400,000, it hits. That qualified business income deduction is 20%. It's proposed to phase out for income over 400,000. And then some other things that I didn't mention, itemized deductions could be limited overall to where you're only getting 28 cents on the dollar. And the biggest is reduced estate tax exemption. It could drop right now, it's 11.58 million. It could drop to 3.5 to 5, which is a huge change. And then let's go over some year-end planning ideas. Colin and I were talking earlier, I'll let him go first, about that capital gains and qualified dividend rates and some of the clients he is working with that have the offshore reinsurance companies. Colin, do you want to give an example of that?
Sure. Can you hear me okay, Shay?
Yes.
Okay, good. My headphones are acting wonky. All right. So one thing to consider, so we work with quite a few dealers who have offshore reinsurance companies, and that's just not specific to dealerships, but that's just an example I'm going to give you. You know, since you have offshore reinsurance with, you know, construction contractors and many other businesses, but when you're dealing with a reinsurance company, you're getting the deduction of the expenses in the operating company at ordinary income rates. And then you're able to defer. And then when you take the money out through an actual dividend at a later time, that comes out as a capital gain. So if you look at the slide here, many of those reinsurance company setups allow you to be able to take earned premiums out as loans. So when you take it out as a loan, that loan is not taxable because you're not really taking the money, you're really just borrowing the money. If the laws change and the rates change, you can see on here that capital gains rates would be, right now are dividend rates are 20% plus the 3.8% net investment income tax. They're going to go up to 39.6% under what's being proposed. Now, this doesn't mean it's going to happen. Remember that. This is hard to plan when we don't know what's going to actually happen and when it's going to happen. But if you've been deferring a lot of these earned premiums to a future period, you might be deferring them to a period where you have higher tax rates. Now, am I telling you to convert all these loans to dividends and get your 1099 to go ahead and create taxable income in 2021? Not necessarily, but am I letting you know that it's something you really need to think about and consider? The thing we don't know is, will these happen, first of all, and then when they do happen, if they happen, will it be 2021 or will it be 2022? So if you currently have loans outstanding, you can talk to your administrator and find out how easy it would be to get those converted to dividends because the cash is already out. And if they say, yeah, this is simple, then they might be able to retro it back effective 2020 if this in fact happens in 2021. Or if it happens for 2022, you can get it done before 2021 is over. There's many, many, many other examples like this where if there was certainty in the tax law, we would certainly have strong opinions on recommendations that we would have you make. You know, explicitly gifting, that's a key item, and there's many other items as well. The real question is, do you want to be aggressive at deferring income or creating deductions in 2020 to defer that income into future years, when future years we might be looking at, or likely will be looking at, higher tax rates? And that's, nobody likes to pay tax now. Sometimes it's better to pay tax at a lower rate than it is to pay tax in the future at a higher rate. I'll turn that back over to Shay. He's got a few other items like that.
I agree. And like, if you have a large purchase planned, I mean, it's almost the end of the year, go ahead and move that to 21. I don't think it'll hurt anything unless you just really need it for 2020, which that's kind of a good thing. That means you've had a good year. For estate planning, I mean, if you already have a plan in place, and especially if you have a large estate, then you should go ahead and follow through with your estate plan. We don't know anything right now, and we probably won't know anything for a while. So I would go ahead and follow through with that. If you don't have a plan in place, you should work on that. But you can go ahead and have one set up, and it doesn't necessarily mean you have to pull the trigger and get the ball rolling, but you at least have it set up. There's not a downside to putting these plans in place. For the end of the year, utilize that charitable contribution. Remember, you can do cash contributions and they're not limited. If you still need assistance due to COVID, you may still have time to take a distribution out of your IRA. Or if you took that required minimum distribution, or you're going to take it by the end of the year, you can do the qualified charitable. It's directly out of your account. Review your portfolio position. You still have time to make changes in your portfolio. So there's still time. I know we're at the beginning of December and the year is ending quickly, but there is still time to do some things. Again, like Colin mentioned, for 21 with the proposed administration, we just don't know. So just have a talk with your tax advisor or with us about what we think the best option is for you.
That was great. We really appreciate that update, Shay. There will be future updates as well. We will continue with sending out updates through the Ask Us email system, and then we'll be looking for other relevant topics for webinars. And so if you have certain requests that you'd like to make of us that you think would be great webinars for us to put on, keep this going. We'd love to hear from you. I'm going to turn this over to Patrick in Denver to wrap this up. We do, Katie sent a link. If you need help with your PPP loan application, we're happy to help, helping with a lot of our clients. Patrick's our quarterback on this, this fun project. I know we've got a few other questions that have come through. I'm going to turn this back over to Patrick in Denver.
Yeah, I think just to repeat what Colin said, we've been doing this for a number of clients now. So, as daunting as some of these calculations seem, we've got a pretty good foothold in there that we are willing to help you and your company get what you need to get these calculations done. We're also available just for questions. So you can either contact us at that help me email or on our website at lgt-cpa.com. You can find my contact information, Colin's, Shay's, anything like that. So we're always willing to help. A lot of the questions I think that came up kind of were regarding to the FTE calculation and reductions from that. There is some safe harbor for the FTE reductions if someone is fired for cause or leaves on their own, and you cannot find a replacement for them. One of the things we found is, the FTE calculation is it's a complicated calculation because it's not just over that period of time. You take each payroll and calculate what your FTE number for that payroll is, and then average that over those covered periods. So there's a lot going on in those. So the reduction of one person, an FTE person, if they leave halfway through that covered period, it might not be a full one FTE reduction. You get to count them as their FTE for those, 4 weeks or 5 weeks or whatever they were in during that covered period as a percentage. Same with if you hire someone halfway through that covered period, for those payrolls that they are being paid and working over 40 hours, they count as 1 or 0.5 if less than that, if you're doing the simplified method. So you would average those over that covered period as well. A lot
Patrick.
of, yeah, go ahead.
Oh, I was going to mention, I think you touched on this during the presentation, but the benefit to using the 24-week period is if you get to count all your payroll that you paid within the 24 weeks. And this is just how the calculation works, and nothing's been said that you can't do this yet, but you're in a situation where your payroll is going to be likely significantly more than your loan amount. So if you are having situations where you do have reductions, maybe you did reduce your headcount or there was salary reductions, how the calculation works is you have so much in wages that even with those reductions, you're still above your loan amount. So you're still getting full forgiveness. So that's one of the main reasons we've recommended that a lot of borrowers use the 24-week period. So just
Correct.
something to keep in mind.
Correct. And kind of with that too, if you don't need, like, you can be perfectly fine where you have people that have been terminated for cause or have left on their own that has caused a slight reduction in that FTE. If you're still okay, even with that reduction, you don't have to use them as a safe harbor and try to produce all the documents to prove that either they quit or that they were fired for cause. You just take the reduction and you still have your full forgiveness. So that's one of the things to consider. We try to make it as easy for you, and easy for the banks, because these banks and the SBA are going to be overloaded with the amount of loans that went out and the amount of forgiveness that I don't know how deep they're going to get into some of this stuff. But if you could simplify it where it's just, here's the payroll, here's the gross wages, here's our calculations, and it all ties to this calculation here, and it shows that we have full forgiveness, that might be all they need, and you're good to go. So that's kind of our philosophy. Now that's not everyone's, but we think the easiest is the best.
Yeah, I agree with you. And I had 2 comments. I forgot to touch on this earlier. The first one is about the expenses. Right now, it looks like they're not going to be deductible based on how the law is written, but there is a stimulus package that Congress is trying to get approved right now. And it seems like there's bipartisan support for these expenses to be deductible. And that's like they're saying that's what their intent was, but they just didn't put it in there. So it's possible in the coming weeks that we could find out that these expenses end up being deductible. But I will also mention something that is pretty interesting, because the text of the proposed bills haven't been released yet, so we don't know what everything's going to be in there. But I did see that they are allocating more funding towards the PPP program. So it seems like it might be possible that there could be a second wave where you could apply again. I feel like the requirements to be able to apply are going to be a lot more strict because of the questionnaire that's come out and whatnot. So I think just with that possibility that there might be a second wave, it is pretty important to get the process started sooner rather than later, because I would have a feeling that you might have to complete the first process before you can start the second, but that's just my hunch. I'm not sure.
Yeah, and it would not be uncommon for a week or two after we do one of these webinars for them to come out with guidance that change something that we said. So I would fully expect that as well. Finally, I think the last question on there is just a clarification on these expenses and being taxable versus non-taxable. our position is that there is a book tax difference currently right now on how you would record these. For book purposes, you would record the full amount of your payroll costs, and then when it gets forgiven, you record that as net income to your company. For tax purposes, those payroll costs that you're using for the forgiveness are currently non-deductible. So there's going to be a difference where for book purposes, you could have, if your loan is $1 million, you could have book income of $1 million difference than your taxable income. But I hope that helps clear it up for everyone. If you have more questions, please reach out to us. But we appreciate your time today. Thank you, the LGT team, for helping put this together as well, and our marketing team. But thank you all for attending, and have a great day.
Thank you, everyone.
Thank you for joining us. LGT will continue this series throughout 2021 as updates are released. As the situation is constantly evolving, please make sure to follow our events page for more information. The link is in the description below, along with other important links, including our social media. If you want to see more of the past Lane Gorman Trubitt COVID-19 financial webinar series, subscribe and hit the bell icon for notifications.